Hello everybody, welcome back to the Miracle Perspective, and this is the TMP Q&A Wednesday, where you ask and I perspectivize. We've got another question from Tandiwe. Tandiwe goes like,
okay, Miracle, this is for the Miracle Perspective. So, I was having a conversation with my friend and we're talking about she feels like she wants to do all her financial mistakes now so that by the age of when she gets to dating, then she can try to recover from all the mistakes. Is it possible to find someone that can tell you the mistakes that they made in their 20s financial wise and what they feel they could have done differently? Like, I feel like I want to invest, but I'm not even sure on which investment is good. You know, in your 20s, there's that pressure wanting to get a car. Everyone is getting a car, moving out of home. Like, how can you go about, like, making sure that you start building in your 20s so that by the time you get to your 30s, maybe your investments or whatever that you did can start paying you off?
I love this question. This is an amazing question. Thank you, Tandy, for this question. I got 3 gentlemen to help me with this, and they're coming from different experiences or backgrounds with regards to finances. So the first guy is by the name of Sibongiseni. This is what he said.
In terms of investment, which route should I take? So let me share this short story briefly. As you know, I'm part of Toastmasters. So in order, to practice my speeches and stuff, on Youth Day last year, I decided to practice my speech on Youth Day here at ARCW. So that speech was about, it was a motivational talk basically. I was talking about 3 principles of success, and one of them was mentorship. And then after that talk, one professor came to speak to me about, what do I really mean about mentorship? Do I really understand what I said about it? And then I shared my knowledge that I like what mentorship meant to me at the time. And then, funny enough, she even go to an extent of asking me if I had ambitions of starting my own business one day. And I was like, yeah, sure. As soon as I finish my studies, I wanna work, of course, but then I also wanna do like some kind of a work that will allow me to run my own businesses on the sides, like, something like a side hustle, stuff like that. So, and then she's like, what idea do I have? Do I have any kind of plan so far? I was like, yes. My main focus now, I've done a lot of research on it, is property investment. And funny enough, this person who was asking me all these questions is already, I could say, a guru in property development and investment. And she offered to be my mentor because she felt like I understood for a student what mentorship was all about. Even the fact that I could be able to give a motivational talk and talk about mentorship. So I was excited to hear that from her. And then she told me like 2 things at the time that were very important when it comes to investing in property. So what I'm saying all this because this is what I feel and I believe she can consider investing on property. You will never go wrong in that route. So 2 advice she told me last year after that talk was, 1, before you buy property, there are 3 things you must remember. Location, location, and location. Those are the 3 things. Location is very important when you invest in property. And the second thing is this, that she needed me to do at that time. She said, you know what, I understand you're a student, but this is what you should do. Go and open a bank account. I need you to go and open this bank account and then make a saving account out of it. She said, go to a separate bank. I was using FNB at the time, so I went to open a Capitec account. And since then, I think it was a week after that talk that I went to open this Capitec account. And then within it, I created a savings account. So she said, you know what, I understand you are still a student. Do this. Whatever amount you have make sure you always transfer it every month into that savings account. And then after a year, come and see me again. Remember, this was June last year. Okay, so I did exactly that. I opened that Capitec account, opened the investment account. So every year, I think I put it was always 250, the investment part, the investment account. I made it like a debit so that every month it just goes automatically to my savings account, that 250 rands. And then every now and then when I have like extra cash, I'll just throw in there. But it wasn't much. And I just checked this morning, I saw that I've accumulated over 3,500 rand ever since June last year. So you just reminded me to go and ask her again, what should I do? Because I have this amount of money now. What's the next step? What kind of advice again should I carry on regarding, building or starting my investment profile in property? So I believe this advice was for me to build a profile. So yeah, I can't wait to hear from her what she's gonna say.
That's Sibongiseni. Guys, Sibongiseni is a very good speaker. I know him because I come from the same club, the Toastmasters club with him. He's a wonderful speaker. So if you want to book him out for motivational talks, talk to him. His details are down below on the screen. So the next person that gave me their views is a financial advisor working for an accredited financial company. So you can also contact him should you need advice on your finances and other legalities on your finances. This is the guy.
Instead of making financial mistakes, let's make financial investments. The only way to do that is if you get financial knowledge. You don't need to waste your 20s financially and then recover in your 30s. You could have made enough money for something in your 30s, in your 20s, while you're in your 20s. So you don't go through life without knowledge about everything. But here we're specifically talking about financial knowledge. You don't need to hear someone's experience right now for you to make financial decisions. What you need is real financial knowledge. This is not someone's experience. This is financial knowledge that's going to help you make savvy decisions financially.
Interesting. Let's hear the practical example of what he's talking about.
Let me give you a practical example.
Yes.
Let's say you want to retire at the age of 65 with say 3 million lump sum, or you want to withdraw every month from the age of 65 going old age. You want to withdraw every month 20,000, and then you start working at the age of 24. Did you know that for every year from age 24 that you put away money for retirement is every year that you will start withdrawing that money? Let me put it nicely. At the age of 24, if every month you put away, let's say you put away 5,000 rands in your investment account, is every year, every month at retirement from 65 that you will withdraw about 20,000, the same 20,000 rands, and taking into account inflation and the buying power of money at the time you are 65 from now. So people don't know this. A lot of people just think, my company has a retirement fund, and then they will look after me every time I work. They will take this, I put away that, and all of that. When you get there, they're like, okay, here's your money, so we are going to give you this much, and then you will see what to do with it. The good thing about that is that the government has changed that law. They're going to give you 1/3 of the whole retirement money. And before, something that they don't know is that before that money gets into your hand, they tax it. And not just tax it, but if you retire having debts, before it gets to your hand, that 1/3, your creditors, the people that you owe, comes through for you. Before the money gets to your hand, they take something. And whatever is left is your lump sum. And then the remaining 2/3, they show it to you, but they don't give it to you. Then they give you a choice. They can either pay it to you monthly, meaning The minute they start paying you on the first month, it means that it goes down. It doesn't go up. They pay you all the way until it gets to zero. And if it gets to zero in the next 4 or 5 years, then you are done. Then you become a SASA pensioner now. You understand what I'm saying? But if you take the 2/3 and put it in an investment account with an investment house, then they will grow that money for you while they're withdrawing it to you every month. Do you understand what I'm saying? So this is the type of financial knowledge that people need.
And that is Mr. Kulu. Please do contact him for financial advice. He is a professional in that field. And then I got the next person who's also a financial expert. He has his own website. It's going to be on the details below.
Hi Miracle, it's Martin here from the Wealth Drive. I'm just making comments here on the voice note that you received from Tandiwe about a friend that is in her 20s. I think it should never be your aim to make all your financial mistakes in the 20s and then try to recover in your 30s. The aim should always be to try your best regardless of what it is that you do. You always make mistakes on the way, but the aim for success rather than failure. The earlier you start making good financial decisions, the easier it will be for you in the long run. So don't think I earn so little that there's no point. I'll make up when I earn more at the later stage. It is a mindset that you have to get right, and you should always save, let's say, between 10 and 20% of all income, regardless how much it is. So rather a mindset than anything else. In the end, there should be one goal, really, and that's to obtain financial freedom. What is financial freedom? When your assets generate sufficient income to cover all of your expenses. At this point, you no longer need to work and you can do whatever you want to or whatever you choose to do. If you want some rules that will help you to achieve financial freedom, then it would be firstly and the most importantly to spend less than you earn and invest the surplus. This is easier said than done. Most people do not achieve this. So again, it would be firstly, most importantly, spend less than you earn and then invest the surplus. To create an emergency fund would be your second step. That should cover all of your expenses for a minimum of 3 to 6 months. I would leave that in something like a money market account so that it's immediately available when needed. But this is for real emergencies like losing your job, not some shoes that are on a great special. Then education, I think, is one of the most important or the most important thing after not spending more than you earn. And reading financial books, where I could recommend 3 just off the bat. Robert Kiyosaki's Rich Dad, Poor Dad. This is to get a good understanding of the flow of money, assets and liabilities, income and expenses, and that'll let you grasp that your house you live in and the car you drive are not assets. Another great book from Ann Wilson, The Wealth Chef. She has really an ability to really easily teach you how to handle your finances. And then Warren Ingram, Local, Become Your Own Financial Advisor, was also enjoyable to read. Then point 4, I'd say do not purchase anything if you cannot pay for it in cash, excluding, of course, property and car, for instance, in the beginning. If you want something, save for it and then purchase it. Do not purchase it on terms. Chances are that if you save first or have a save first mentality, by the time you have sufficiently saved enough to purchase whatever you wanted, you no longer want it. So it's a great way of avoiding impulse purchases.
Nice.
Then to get income, avoid any get-rich schemes. Anything that tells you that you can get returns of, let's say, 20% or more, stay very far away. And anything with advertising that has fancy cars, beaches, nice double-story houses, and that, just keep away from that. Chances are it is a scam. Only after you've done all these other points would I suggest that you start looking at investing. If you really want to, a platform that I enjoy, find easy to use, is Easy Equities. And there you could use something like purchase initially something like an index tracker, like the S&P 500, something that aspect, just not being financial advice, but something that you can just track the market opposed to individual shares. And later, if you know a bit more, then you can start looking at individual shares. Cool. I hope that helps. Great. Thanks. Bye.
Thank you so much, gentlemen. Thank you guys for your perspectives and your advices on this issue. And I feel like It's a very important matter. Thank you for this question, man, because a lot of us in our 20s, we make a lot of reckless decisions when it comes to finances. We don't know how to manage finances. We don't have the financial education, and that's the problem. We make a lot of money over our lifetime, but we cannot account for that money. So I'm just going to read a few things I wrote down just as facts and ideas for you to think about, because you asked a very valid question, and I'm in the same boat as you, but I consider myself as better than the average peers of mine, because I am someone who's been very dedicated into my financial education. So I pay a lot of money to attend financial literacy courses. I paid a lot of money to attend seminars about finances. So I am a person who is I understand my finances. I know where my money is coming from. I know where my money is going. All right, here's the thing I'm going to suggest for you to use. In taking the first step in understanding your finances, get an app to help you manage your finances. I use I Save Money. I Save Money. I Save Money. Download that thing. It might be a little bit complex if you are just a beginner on the app, but get any app to help you understand your income and your expenses. Categorize all your expenses. You know where your money is going. At the end of every month, be your own financial, be your own CA. Manage, audit yourself, audit where your money went. Check your account, balance your finances at the end of every month. So that's the first step. Understand your money. Know where your money is coming from and where it's going. So here are the few things that I'm going to just share with you. By the way, I am not a financial advisor. I am not a professional in the field, and by no means is what we are sharing on the channel financial advice. This is not professional financial advice, so we are not giving you any financial advice. We are not professionals in any way. I am not a professional for that matter. So whatever I'm giving you, it's my personal perspective and point of view. So I'm going to read you some of the things that I wrote down to just help you think as well. Also, as a pointer, it's very important to make you aware that I am a student of Warren Buffett, Robert Kiyosaki, Patrick Bet-David, and the wealth coach of coaches, Conrad Labuschagne. I've attended a lot of courses from Conrad Labuschagne. They are amazing. I would recommend them to anybody who wants to understand money. Financial literacy is key. So with your comments on the section below, do say if you're interested in knowing more about the education I have in terms of finances. I can link you up with some of the courses from Conrad Labuschagne. I've been a student of him. I am still a student of him. He shares amazing stuff. So, number one, about 95% of South Africans will have insufficient funds to retire. The point here is avoid being one of those stats. And number two that I'm going to read, Warren Buffett once said, if you buy things you don't need, soon you will have to sell the things you need. Deal with the psychology rather than the activity or the avenue of investment before you go into any investment avenue, because it's very important to understand the psychology of investment. One thing that people are so misled, or they just don't understand this element about money, is the idea of putting your money away and forgetting about it and getting it in bundles. It hardly ever works that way, hey? Because wherever your money goes, you need to understand where it's going. That's why they usually say do not invest in things you don't understand. Investment is just a business. You are running your own business. That is why if you are not ready to be in charge of your finances in terms of investments, knowing where your money is going, how the markets are performing, how long you're investing for, give your money to a broker. Give your money to a financial services provider. Give your money to someone or the bank, because that's the safest place to be. They'll give you that 5% end of the month, end of the year. But also you need to pay attention to the buying power of money, the value of money. Your money will be safe. Yeah, example. Your money will be safe in the bank, because at the end of 5 years, 10 years, whatever years, you will see it as that 10,000 rand that you put in. But it does not represent the value of the money in terms of buying power. Practical example. What you could buy 5 years ago for 5,000 rand, you can only buy half of that for the same 500 rand, 5,000 rand 5 years later. If bread was 5 rand 5 years later, today it's not 5 rand, it's going to be 10 rand. So the money value has halved, it went down. So money halves every 5 years. So that's something that you need to be aware of. But if you're not willing, if you're not ready to take advantage or just be in control of your own finances, put your money in the bank and be ready that when you get it after whatever period of time, it will be less valuable than what it is today. So you choose the struggle here. Do you want to be in charge and in control of your finances, control your investments, see where your money, what your money is doing, or do you want to be that person who says, this is too much for me. I'd rather give it to the bank or a financial service provider. It's up to you. So, another thing. This is going to be longer, man. Here's the thing. It's very hard to deal with this financial topic in a very limited amount of time because it's very deep. It goes beyond what we are just talking about. And I try to refrain a lot from giving you things to do. I don't want to give you what to do. I want to give you the psychology behind what to do so you can make your own decisions, make your own informed decisions. Because I don't want you to neglect the responsibility of taking charge of things that you should do. So I want to give you the psychology behind the things you should do. And one of the things that work for me in terms of my money management is I have taught myself to not see the money I have as the money I can use. So what I do is my bank account allows me to create multiple savings accounts. So what happens is when money comes in on this one account, I call it my payday account. Wherever the money is coming from, it gets here. So because I don't want to see a huge lump sum of money in one account, it will mess up with your mind. You feel like you have a lot of money, you just swipe. You don't see where the money is going. What I do is I just distribute. I break it down into pieces, into different accounts. I have my Pay Me First. Oh, by the way, another book I'm going to recommend for you is The Richest Man in Babylon, because I got this from him. Pay Me First principle, where you take money, it's your investment money. Basically, you pay yourself first. It's money for the future, for the rainy day. I take a certain percentage, I put it into that account. I don't touch it. So I teach myself, I brainwash myself to not consider that money as mine. So I don't see the money, although it's there on my account. But with training over a long period of time, I have learned to not see that as money that I can spend. And that is the point. Break down your account into many accounts so that you distribute the money. When you receive your money, distribute your money, and you know that, okay, this is the money I have to spend. The rest is not mine. And yeah, the other stuff, I've got a lot of things to share, guys, but I can't share it because it becomes longer in the video. So I'm just going to share that, and I think this is a conversation that has just been opened, not closed. Let us talk more about this. I'd like to receive more of your questions, and I will try my best to get experts in the field and just to come and tell us in practical terms how to manage finances. Also understand that right now, this is from Ray Dalio, at this time that we're living in, the pandemics, money is very volatile right now. Cash is very volatile right now. You do not want to hold cash. You want to store the value of your money because the markets are very volatile right now. So currency is volatile, meaning you are holding 10 rand. Two years later, you'll still be holding 10 rand, but your 10 rand will not buy the things you were able to buy today. So your 10 rand will halve its value. So what do? You want to invest in an asset that will maintain its value, an asset like these precious metals, and that's your gold, that's your rubies, your silver, because they maintain their value regardless of the inflation, regardless of the fluctuations of the currency itself, because currency is not money, it's just currency. So the value of gold will hold its value. Gold will hold its value. So invest in those things. And if you want to know more about this, as I said, I'm a student of Conrad Labuskaghni from Work Your Wealth. comment below if you're interested in this, and I will hook you up with their sessions where you will find the best avenues to invest in gold and in other asset classes, income generating assets and all the likes. And one more thing before I leave. If you are really, really interested in building wealth, if you are interested in wealth creation and you want to be safe, you want to be a person who's in control of your finances, forget about the credit score. Forget about building a credit score, because the only thing the credit score is interested in is to check how much you love debt and how much you can manage debt. That's what it's concerned about. It has nothing to do with how much you have as an individual. It has nothing to do with your buying power and your buying capability. It only measures how much you love debt and credit. So forget, you cannot live your life on credit. As Martin has said, if you are interested in buying something, save up for it. And you can't afford it today, save up for it. And when you have that enough money to buy it cash, you might find that you don't want it anymore. So it's a way of saving up your money and killing those impulsive decisions of making purchases. So yeah, forget about credit score. It's not going to help you. From me to you today, I think this is an entry point to a very important discussion that we need to engage in. It's finished.